Ladies and gentlemen, good day and welcome to the Cantabil Retail India Limited Q4 and FY26 earnings conference call. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Before we begin, a brief disclaimer. The presentation which Cantabil Retail India Limited has uploaded on the stock exchange and on their website, including the discussions during this call, contains or may contain certain forward-looking statements concerning Cantabil Retail India Limited business prospects and profitability, which are subject to several risks and uncertainties, and the actual result could materially differ from those in such forward-looking statements. Should you need assistance during this conference call, please signal an operator by pressing star then zero on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Vijay Bansal, CMD Cantabil Retail India Limited. Thank you, and over to you, sir.
Good evening, everyone. On behalf of Cantabil Retail India Limited, I extend a warm welcome to all participants joining us for the Q4 and FY26 earnings conference call. Joining me today are Mr. Deepak Bansal, Full-Time Director, Mr. Basant Goel, Full-Time Director, Mr. Surendra Nigam, Chief Financial Officer, Ms. Poonam Chahal, Company Secretary, and our Investor Relations Advisor from Merchant Capital. We trust you have had the opportunity to review our Q4 and FY26 results. The earnings presentation and financial statements are available on the stock exchanges and the company website. Financial year 2026 was another landmark year for our company, marked by record performance and sustained momentum across our products portfolio. Strong brand recall, expanding market presence enable us to deliver industry-leading growth and highest annual profit despite a challenging global environment characterized by geopolitical uncertainties, supply chain disturbance, and volatile input cost. We also achieved our highest ever EBITDA, reflecting the strength of our operating model, disciplined cost management, and scale efficiency. Over the last 5 years, we have consistently delivered strong results with a revenue CAGR of 22% and a PAT CAGR of 26%, reaffirming the effectiveness of our long-term growth strategy and focus on sustainable value creation. Our resilient business model, supported by prudent financial management and a strong balance sheet, positions us well to navigate near-term uncertainties while continuing to invest in growth opportunities. I now hand over the call to Mr. Surendra Nigam for giving update on the financial and operational performance. Thank you.
Thank you, sir, and a warm welcome to everyone. Now presenting the number. Standalone performance highlights for FY26. Revenue from operations for FY26 grew by 18% to 852.6 crore as compared to 721.1 crore in FY21. EBITDA for FY26 grew by 29% to 264.3 crores as compared to 204.8 crores in FY25. EBITDA margins for FY26 improved to 31% as compared to 28.4% in FY25. Our PAT margin for FY26 grew by 28% to 95.8 CR as compared to 74.9 CR in FY25. PAT margins for FY26 improved to 11.2% as compared to 10.4% in FY25. Coming to standalone performance highlights for Q4 FY26, our revenue from operation for Q4 FY26 grew by 15% to 253.5 CR as compared to 219.8 CR in Q4 FY25. Our EBITDA for Q4 FY26 grew by 34% to 78.1 crores as compared to 58.4 crores in Q4 FY25. Our EBITDA margins for Q4 FY26 improved to 30.8% as compared to 26.6% in Q4 FY25. Our PAT for Q4 FY26 grew by 13% to 29.2 crore as compared to 22.5 crore in Q4 FY25. Our PAT margins for Q4 FY26 improved to 11.5% as compared to 10.2% in Q4 FY25. On the operational front, we continue to scale our efficiently with a total of 652 stores across the country, covering a total retail area of 9.15 lakh square feet. These results affirm the strength of our business model and our ability to drive consistent, high-quality growth. We may now begin the Q&A session. Thank you.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and one on the touchtone telephone. If you wish to remove yourself from the question queue, you may press star and two. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we'll wait for a moment while the question queue assembles. The first question is from the line of Abhi Jain from AJ Capital. Please go ahead.
Hi, good evening. Hope I'm audible.
Yes, please.
Hi. So I just wanted to understand something around the same store sales growth. Obviously, you have a good track record.
Your voice is not clear. Can you please repeat the question?
Is it better now?
Yes, please.
Yeah, hi. So, sir, I wanted to understand something around the same SSG, which is the same store sales growth. Now, obviously, you have a great track record of 10 years, the PAT and top line on a consistent basis. But what I've observed from the data is that, your SSG seems to be, highly correlated to the monetary policy. So whenever the monetary policy is loose, we see an uptick in your same store sales growth. And whenever there is monetary policy tightening, the SSG takes a hit. And given the inflationary environment that we are in right now, it is not a very difficult thing to assume that in the next 12 months we might start seeing monetary policy tightening again. Can you help us understand if there is any lever that you guys are thinking, or the management is thinking of pulling to save this, expected decline in the SSG, which is highly correlated to the monetary policy? Or have you thought about it? Because the data clearly shows that. So if the monetary policy tightens, discretionary spending will take a hit, and I'm pretty sure that the FSG of Cantabil will also, take a hit. So any thoughts around that?
Our SSG last year was around 5%, and in April also our SSG was around 5%. So monetary policies right now is not hampering our SSG growth, because in May also till now we are getting a decent SSG. So in the past also, yes, monetary policy constrains the customer pocket, but due to our efficiency practices and the adopting some incentive policies at the front end, and by the marketing activities, we are able to get the SSG in the tightness of the financial policy also.
Okay. So, on a medium-term basis, you are pretty confident that this SSG of this 5 to 6% will continue despite whatever the monetary policy or repo rates are. Even if the repo rates increase to more of 100 bits, you are pretty confident to maintain the 5 to 6% SSG, right?
Yes, we are continuously delivering for last many years, 5 to 6%, that we are being promising. We are targeting more, but at least 5 to 6% of the same store growth is absolutely on the track.
Okay. All right.
And long-term
no, that's helpful. Thirdly, sir, what I want to also understand is that, obviously I'm looking at the top line, and this year around, it has been around in the 15 to 16% range in Q4 we are talking about particularly. So can you just give us some sense into your, the new store openings that you're seeing? How do they compare to the existing stores? I mean, in terms of your break-even points, in terms of the adaptability, because now you're venturing into newer markets. So I just want to understand how well are new customers adopting to Cantabil.
So our new stores are giving very good response. So last year we opened around 53 stores, and right now also around 45 stores are in the pipeline, and all stores are performing very well. So we are not facing any challenge in the new markets or such. and the old stores, as you have noticed, SSG is doing 5%. So overall, the combination of old stores, new stores are giving good revenues to the company.
Okay. All right. Thank you, sir. That's it from my side. All the best.
Thank you, sir.
Thank you. The next question is from the line of Tarun Sharma from Anand Rathi. Please go ahead.
Hi. Good morning. Good evening, actually, and congratulations on a great set of numbers. I just had a couple of questions. So, are we seeing any price hikes that we would also be adopting, considering how the raw material situation is? And are we seeing any impact of raw material pricing increase in our input cost?
So yes, this is actually sale price is obviously dependent on our cost price. Directly, already the season's merchandise is there, but as of now, we have some input material has been taken some hike. Yes, some cost is to be bear by the customer and some buyers. So it's a mix and match. Yeah, our selling prices are dependent on cost.
Okay. And are we seeing any early trends of impact of the cost on maybe considering the footfall as well? Because of are we seeing good response currently as well?
The footfall is good because we are getting the SSG till now. So footfall is fine till now. So no impact on the footfall side.
Yeah.
Okay. I also had one question on the balance sheet side. We have 25 crore shown under loans. Can you just explain a bit on the nature of the same?
So we have given an intercorporate loan. Honestly, we are having a fund surplus we have. So we are getting some good amount of returns. Normal market returns in terms of fund is approximately 6 to 7%. This we have been given on 12% secure. So for 1 year. So that is for the better return only.
Okay. I'll thank you for this, and I'll just join back in the queue for any further questions.
Okay, sir. Thank you.
Thank you. The next question is from the line of Ankit Shah from White Equity Investment Advisors. Please go ahead.
Thank you for taking my question. So my first question is on store lease rent. Can you share the number for FY26 and the estimate for FY27?
Yes, if you see in the cash flow, because Indian 116, that expense is on the bottom line of cash in the financing activity. So that is approximately 100 CR for this financial year. And 5% almost increment plus new store, it should end up approximately 108 to 110 by the next financial year.
Okay. This is the actual lease rent cost that you will be paying, right?
Yeah. This is the payment of lease borrowing and the payment of interest on lease liability. This is approximately 95% is the actual lease rental, what we are paying.
Okay. So of this 100 crores, you say 95 crores would be the actual outgo.
99 crore is my actual rental cost for the financial year FY26.
Okay. That's helpful. Yeah. So the average bill value is going up by approximately 10% per annum. What would you attribute this to? I mean, what's going right for us in this, and the likely trajectory for FY27?
So yes, this is a mix of obviously some sort of inflation is there and the better mix in terms of margins, better product margin, because we are maintaining 60% of the gross margin. So this year also some better due to optimization of product. It would be better than existing one. Exactly what will happen, that will take time, but some part would be better than for this financial year.
Okay. So the store addition is slightly slower than the planned trajectory. So we had planned for 675 stores by F26. So where are we missing, and what's the trajectory for next year?
So the same thing. Actually, these are in my earlier calls as well, earlier commentaries, if you say last 1 year or 1.5 years. Now we are every year 10% of our total store, that is out of 650, come for the renewal because 9 years lease been completed. So this year, actually, we have opened 91 stores. Numbers are looking 53. 91 stores have been opened. We have been ahead of our target, right? But out of this 91 stores, 38 stores will come either on the renewals or there are few performance-based closures as well. So largely out of these 38 stores, 24, 25 stores are the renewals where we get the better opportunity. They are relocations, and 13 stores approximately on the performance side. In this financial year, in fact, we also opened 91 stores. And going forward also, FY27 target is online, 1,000 crore of revenue and 725 across the number of stores.
So we are currently at 650 plus stores. So we plan to add net 100 stores in next 1 year, or is it gross 100 stores?
Gross 100. To be honestly, we are looking for the square feet as well. We have added 1 lakh approximately 11,000 square feet this year, right? So if you see 53 to 2,000 square feet, however, my stores are bigger. 1,700 is the area for this financial year. So net number, we are targeting to open 90 to 100 stores. Net numbers maybe 70, 75. That depends.
Got it. In the square foot, the area, we should be looking at 15 to 20% per annum addition approximately, or should that be different?
We are targeting that. 15 to 20, 15% minimum. 15 to 20 depends. That depends on the location of the store. But we are targeting this much of area.
Okay. I'll join back with you. Thank you.
Thanks, sir.
Thank you. The next question is from the line of Swapnil Gupta from White Pine Investment. Please go ahead.
Hi. Thank you for the opportunity. My question is related to the gross margins. So in FY26, we made about 60.4% gross margin, and it is continuing the improving trend from 56.2% in FY24. So going forward, is this 60% margin sustainable?
Yes. The margin what we are targeting on a long-term basis is approximately 16%. Any of the commentary we are giving is getting better than that. However, 1% may be up and down would have been there, but the overall target to maintain 60% of the gross margin.
So in FY27, if you will also, due to the inflation, will also raw material price increase. So with all those things, we still maintain our 60% guidance.
60% is the guidance. For us, our internal guidance is to maintain the gross margin at 60%.
Okay, thank you.
Thanks, sir.
Thank you. Before we take the next question, we would like to remind participants that you may press star and 1 to ask a question. The next question is from the line of Arjun Gaikwad, an individual investor. Please go ahead.
Hello, am I audible?
Yes, sir.
Yeah, so I just wanted to ask, I wanted to understand the rationale behind not accelerating franchisee-led growth as to why are we not focusing on franchisee stores?
Company DNA is from the very start was about the COCO stores. So we open the franchisee stores also. So we have around 20% franchisee and 80% company. But as we are doing bigger stores, we are doing the high rental properties, prime locations. Naturally, sometimes franchisee are not comfortable with very high investments, properties with high rentals. So company go for the COCO stores and that in those places. But yet in the tier 3 markets where the rentals are less, investments are less, we are getting franchisees. We have around 20% franchise and 80% COCO.
Okay, sir. Thank you.
Thanks, sir.
Thank you. The next question is from the line of Ankit Shah from White Equity Investment Advisors. Please go ahead.
So thank you for taking a follow-up. So the OPEX cost has been under tight control. Can you help us understand how you are achieving this and the trajectory going forward?
Sir, this is regarding CAPEX cost?
OPEX. So employee costs and other expenses.
Yes, sir. So overall our cost has been, we are maintaining our overall cost. So obviously when the sales is going higher side, in terms of percentage it comes down. Like my retail cost last year was 34%, this year came down to 33%. So we are always been known as a very tight negotiators, and so that OPEX cost has been maintained. We have very fixed parameters in terms of operating front-end costs. It came down the moment sales goes up 34 to 33%. We have 8% of the back-end corporate costs. These are the costs which have been under control. Yeah.
Got it. And we expect the same trajectory, the same kind of operating leverage to play out in the next 2-3 years?
Absolutely. In terms of percentage, if you say, it would be, we are hoping not to cross that. Maybe plus minus 1%, it is different thing. Otherwise, largely it will be in the same range.
Got it. Sir, can you throw some light on footwear sales? Can you give the numbers and the expectation for FY27?
Footwear, right?
Yes.
Footwear, yeah?
Yeah. The footwear sale last year was 10 CR, and this year we did 14 CR, so there is 40% growth in the footwear sales.
Right. And what is the expectation for FY27?
So it's the same rate. Like this year, last year, we have done approximately, it's a start, 1.5%. This year, we're almost on the target of 2%. So going forward, we have a target to increase it. Maybe end up this financial year 3 to 4%. We have plans. Yeah.
Got it. So we would be introducing this more across more and more stores, or all family stores, or how is it?
We are planning it majorly for the online sales because we are getting online traction more in the footwear. So growth we are forecasting from the online channel.
Got it. And sir, can you help us understand a little bit more on the kidswear piece? How is it tracking, and how are the numbers doing?
Kidswear.
Kidswear we are around 2 to 3% of total sales. So we are opening new family stores. So last year also for 45% family stores are, we total stores 45% of the family stores. So in the family stores we keep kidswear. So kidswear sale is going to grow. But next year we see it around coming to the 4%, around 4.5% of total sales.
Okay. That's it from my side. Thank you.
Thank you. The next question is from the line of Shrinjana Mittal from MS Capital. Please go ahead.
Hi. Thank you for the opportunity, and congratulations to the team for strong execution. I have 2 questions. So, Shivendra, if you can explain to me that the gross margin has increased from 53-54% to 57% this quarter, so roughly around 350-400 bits improvement from last year. And also seasonality also, if I check this quarter, gross margins are generally on the lower side compared to the other quarters, right? So what has led to this higher gross margin in this quarter? Is it a mix-led thing, or is it also because the footfall was good, so the discount mix percentage was on the lower side? Yeah, this would be my first question.
So you are talking about Q4, right?
Q4, yes.
Q4? Yeah, Q4. So one thing is that there is some, obviously, better efficiency mix is there. It's a mix of efficiency as well as some correction in pricing. GST has also helped a little bit. So these are the mix of these combinations, all 3 combinations. So that is why Q4 was better in terms of gross margin. But overall, going forward, this margin is to be maintained.
Understood. And when you say efficiency, you're talking about in procurement related efficiency?
I will say rather than efficiency, I will say better product mix, higher margin little bit, almost same, but little slightly on a product mix side.
Understood.
Rest of the details, if you want, I can take it separately.
Sure. Yeah. The second question I had, Shivendra, was e-commerce sales number, if you can share for this quarter and last year, same quarter, the absolute sales number for e-commerce.
Absolute number for the quarter only, right?
Yeah, for the quarter.
So last year, actually, as I explained earlier as well, my last year online numbers, if I take online numbers, was 988, 10 CR broadly you take. This year it ended up with the 11 CR, right? So the growth is approximately 10%. But in terms of number of pieces, if I'll go, my growth is approximately 13%, because explained earlier as well, because Myntra has major players, which is Myntra and Flipkart is having 70% of the total 65-70% contribution. They have changed the billing pattern. I explained last time as well.
Right.
So overall, if I'll take it in volume, that is approximately 12% growth in quarter as well. 15% in fact.
Understood. Yeah. Thank you. Thanks for taking the question.
Thank you.
Thank you. The next question is from the line of Rajesh, an individual investor. Please go ahead. Mr. Rajesh, your line has been unmuted. Please go ahead with your question.
Hello. Good evening. Can you hear me?
Yes, please.
Rajesh.
Yeah. So more of a macro perspective, just wanted to understand from you, given the current global situation, which obviously has led to some sort of inflationary pressure on the economy, do you all believe this inflationary pressure affects a retail format like Cantabil? Means, does it impact the demand scenario or the demand perspective at your stores as well, or expected to impact?
Yeah, there can be an impact on the demand on the footfalls, but we believe due to our marketing activities and due to our efficient front-end practices, we can manage this sluggish demand if it happens in the future.
So basically then a follow-up to that is, with additional marketing and everything, do you expect that there'll be some pressure on the margins with OPEX costs going up? And so if you can just give me a guidance for, say, FY27, given the current situation on both sales as well as EBITDA?
So the guidance is simple. These are the effects. If you see, Cantabil never been affected by these larges. Few of the months we have very good same-store sales growth, which will be compensated by in few months, right? First quarter was great. Then overall 5 to 6% of the same-store sales growth margins would have been there. Yes, these disturbance on a global level would continue. Number two, whatever the numbers we have been committing in terms of margins, that is a sustainable number. We have completely focusing on our gross margins, which is approximately 60%. The moment we will be able to maintain that, our EBITDA margin 30% will always be on the card.
Sorry, but I just heard that basically additional marketing expenses would be given towards
1.7% as of now. 1.7% as of now. It may go up to 2%, 1.8%, plus minus 0.1.2%, not beyond that.
Okay. And just to follow up on the guidance, what's the projected SSG for FY27?
We are expecting to take it forward from 5 to 6%. Otherwise, 5 to 6% would have been maintained. It may go up to 7-8%, but it's too early for this. But minimum 5-6% would have been there.
Got it. And so just the last question, given there are many categories which is kind of new or more of experimental categories and everything, you think broadly on the inventory front, or basically do you see an expansion in the working capital cycle for you? Means predominantly from an inventory perspective, going into family stores where probably more inventory would have to be stored and everything. So given all these factors, do you see a working capital expansion cycle?
From last year, for last 3-4 years, we have the best this financial year in terms of inventory days as well as working capital cycle. Last year inventory days was 123 days, 24 days in fact. We came it down to 109 days. Our working capital was approximately 115 days this year, which came down to 105 days. We are continuously working on it to maintain it more. Always we said it should not cross beyond 120, and we are trying to reduce. So significantly we reduced it. We optimized it. So approximately near this only 110 days in terms of finished goods inventory as well as 105 days of working capital approximately would be around this.
Sorry, I missed the last part.
105 days of the working capital for this financial year, 110 days was the inventory, and it would be around this.
Understood. That would be all from my end. Thank you so much, sir. Thank you so much.
Thank you, sir. Thank you.
Thank you. Before we take the next question, we would like to remind participants that you may press star and 1 to ask a question. The next question is from the line of Abhi Jain from AJ Capital. Please go ahead.
Thank you for the opportunity again. So I just want to understand that, given the inflation headwinds and the problems, and obviously it will become more sticky in FY28 than it is in FY27. Is there any plan, or are you monitoring, or does it help if you upfront your capex and your store expansion and store opening? Does it make sense to increase the pace in FY27 and then wait and watch in FY28 basis, how the inflation sticks out? Because I think cost optimization, that will be one part of cost optimization that will really help you sustain your margins going forward. So any thoughts around that?
Are you asking about the capex expense going up due to the inflation?
Yeah, the store expansion, so whatever is planned, does it make sense to front load it in FY27, given that, inflation is expected to be sticky globally, and obviously the cost will rise and the interest cost will rise, and all of that will contribute to, cost. So just for cost optimization basis, I'm just thinking.
Interest cost we don't have because we are debt free, and the capex we have planned to lower our capex per square feet because we have right now adopted a new furniture fixture category which has slightly less cost than what we are doing in the previous year. So capex per square feet we think will go down in this year because the new fixture design has been adopted with a lesser cost. So this is how we plan to mitigate the inflationary pressure if it comes in the coming quarters.
Okay. Thank you, sir.
So we have a very clear bifurcation, what we are going to spend, how we are going to utilize our cash flows, that is very clearly bifurcated. How much, because everything is from the internal accrual, obviously we are in sales. So 1800 is the capex per square feet. If we are adding 90, 91 or 100 stores, so that is not. So there is no, in terms of mixing of OPEX or substantiating or replacing OPEX with CAPEX. So things are as per plan. No issue. So it will come down as Deepak said. We will have some saving maybe in the CAPEX one. So going forward, there is no change in plan in terms of OPEX percentage as well as CAPEX for cash flow utilization purpose.
No, that is helpful. It's just that, FY28 looks like a monster thing sitting out there, and nobody knows how it will pan out given the global inflation headwinds that we are seeing. So I'm just thinking that does it help to preempt our efforts towards that and mitigate whatever we can right now in FY27? So, yeah, that was the only plan of what. Thank you.
Can you please?
Okay, thank you, sir.
Thank you. Participants who wish to ask a question may press star and 1 at this time. The next question is from the line of Dharmesh Shah from Equity. Please go ahead. Mr. Dharmesh, your line has been unmuted. Please go ahead with the question.
Congratulations on unexpected line, on the guided line. I have a couple of questions. First is, just wanted to understand what would be the rent.
Sir, your voice has been breaking. What would be the rent?
Mr. Dharmesh, may we request you use the microphone to ask a question?
Yes, sir. Dharmesh.
Am I audible better?
Yes, better now.
Yeah. So my first question is, what is the current rent per square feet?
Current rent per square feet, it has came down to 115 rupees.
Oh.
Yeah, 115 rupees per square feet for the financial year FY26.
Has it gone?
Last year it was 120. This year it's come down to 115.
Okay. Also, in previous calls also and current call also, spoken about increasing the store size. Just wanted to understand on the.
Sorry to interrupt. Mr. Dharmesh, please use your handset while you ask a question.
Am I better?
Yes, sir.
I just wanted to understand on the new store versus old store in terms of the larger store which currently you are using versus the older one, which is smaller in size. What is the benefit which we are deriving from?
So now the concept is not exactly the benefit. We are opening bigger stores now. For last 2 years, our average size, if you say as a journey, it was started in last year from 1100 square feet average size. This year we end up with 1400 is my average size. For last 2 years, my average opening size is 1700 square feet. Obviously, we are opening more family stores. Right. So the benefit is that we have a better portfolio of family stores where sizes are not available. It could be men like Maharashtra, Gujarat, where big properties are not available.
So we have better EBITDA margin in the bigger stores. So
Yeah,
profitability is higher in the bigger stores, and EBITDA margins are lower in the smaller stores. That's why we are opening bigger stores.
Sure. So any analysis which you are saying expected and actual EBITDA that we are deriving?
Expected EBITDA on a company level?
No, for the bigger size stores.
My bigger family stores EBITDA from men's store, if you say, that is plus 1.5%. That is what the large difference is.
Oh,
But it is not pure. This is not a pure parameter for opening a store. There are a lot of parameters. But obviously, when we are opening the family store, they are giving slightly better EBITDA margins.
Great. There was this new corporate office which was supposed to operationalize. Have we moved into the new corporate office come warehouse?
We are having this conference from the new corporate office itself only.
Oh, great. So was this capitalized in FY26 or where will you see this capitalization?
All the building has been capitalized. Overall, the budget was for the building, barring land, was approximately 50 to 55. Almost everything has been done, and it has been capitalized in the book, and balance sheet has been taken the depreciation effect of this as well.
Okay. Sir, in terms of warehouse, I understand that the new office also had a warehouse. So what would be, how large is the warehouse? How much additional store it can cater to?
So this building is 11-story building where we are having 4 floors for corporate office and 4 floors have been used for online warehousing. So this has been completely automated with WMS. So this has been building, 4 floors has been dedicated for the online warehousing. Our offline warehouse is still separate.
Does that mean we will be catering to our online sales or
from this built warehouse?
Okay, great. Sir, one last question. Recently a follow-up question. There was this loan. Is it given to some related party or it's an external?
Non-related party. For better returns for 1 year only. It will be closed in this financial year.
Sure. And last question, if I may ask, what is the current inventory aging bucket? I'm more interested on knowing inventory above 180 days.
Current inventory aging bucket, right?
Yeah. So essentially, above 180 days, how much inventory would be there?
My 70% of my total inventory, 70 to 75% is within the range of 1.5 years. And then we have obviously inventory provisioning policy for aged inventory, which is in place.
And what is the provisioning policy, if I may ask?
Up to 1 year, that is all fresh material, 0 provisioning is made. 1 to 3 years, 10% provisioning we are making, and anything above 3 years, whatever the number, 50 years provisioning is being made of cost, which is actually going to be realizable. So 1 to 3 years, 10%, above 3 years, 50%.
Sure. That's it from my side. Thanks and all the best.
Thank you, sir.
Thank you. The next question is from the line of Akshay, an individual investor. Please go ahead.
Hello. Sir, since we shifted to new warehouse and corporate office, will there be any saving in lease cost in future?
Reduction in lease cost, right?
Yeah.
Yeah, it would be there. My earlier office building was on lease, so that saving would have been there.
How much will be the saving, and by when we will realize it? Like quarter 2 or quarter 3?
1.5 to 2 CR annually.
Okay, and this will be from quarter 2 or from quarter 1 onwards?
Quarter 2 onwards. Quarter 2 or maybe quarter 3 onwards. Larger effect.
Okay, and this is only for corporate office, and about for warehouse?
So as we explained, like say we were having earlier office, right? Earlier office was there as well as offline warehouse would be there. So in this office we moved, we have a 50% of the office space as well as 50% of the e-commerce warehousing space, right? And then the offline would be moved to our factory, that is already a warehouse, and another warehouse. So this is how we are being managed.
Okay, so this 1.5 CR is total savings.
Annual rental is approximately 2 CR we are going to save from maybe Q3 onwards.
Okay. And regarding what is the future plan for using the cash flow? Because we have given 25 CR this year to some intercorporate loan. So for future cash flows, what is our plan? How we will use the cash flow?
So cash flow would have been, if you see, this year we are having say 50%, 50 CR of my cash surplus. 50% was there, and 50% for a need basis given to non-related parties for better return. But going forward, we have a plan to make a better return in terms of market. We will have a pension plan. Things are in place, which would come from Q3 onwards.
Okay. So we will do more capex from Q3.
100 stores has always been on the plan, then maybe numbers going forward. But cash surplus by the end of this balance sheet would be good amount of there in the balance sheet. And we'll come to you to how better return. We are obviously going to have a return on that. Whatever the best, better return would have been there.
Okay. And last question is, there is around 10 CR in CWIP in balance sheet. Is there anything in progress or what is?
Yes, we are building another floor in our existing factory. So largely part of 10 CR for this my Badugad warehouse, as well as few stores are in pipeline. 1.5 crore is a part of them, which we are going to be open in the month of April in the Q1. So that is there. Then some work is going in corporate office till C12. So that is largely 50% part with by Badugad factory, and the balance is for this office as well as new stores.
Okay, and that will start in Q1, you said, right?
Sorry?
The remaining portion will start in Q1, this quarter.
Which delivery portion?
Yeah.
This is keep on going. We are keen to keep on opening the stores, so always WIP would have been there. Some work is going on in factory as well. So some WIP 4, 5, 6 stores would always be there.
Okay. That's it. Thank you.
Thank you, sir.
Thank you. The next question is from the line of Satyajit Sen from Value Research. Please go ahead.
Hello.
Yes, please. Yes,
hello. Am I audible?
Thank you, sir. Yes, please. Go ahead.
Yeah, thank you. Thank you for taking my question. Just a clarification question. So, in the latest presentation, the sales per square feet for FY25, you have taken as 763 rupees. But in last year's presentation, it was 784 rupees. Have we just expanded the base for the square feet that we have taken?
Yes. Actually, when we are moving to new software, we reassess all the areas. So there was some old stores where area was, then we expanded this area. So 5% of my total area, you can say 20,000 square feet on our old stores has been expanded. That is why marginally per square feet is looking down. So we corrected everything.
All right. My next question would be I just wanted to know how far do we reach maturity for a larger family-owned stores?
So broadly, maturity period is still around 1.5 year to 2 years for maturity when they are started giving their full sales. However, the break-even period is 6 months for any of the stores. So largely these parameters are same, whether for men's or family stores.
All right. Thank you. Thank you.
Thank you, sir.
Thank you. The next question is from the line of Ankit Shah from White Equity Investment Advisors. Please go ahead.
Thanks for taking a follow-up. Sir, are we expanding our manufacturing capacity?
So manufacturing is still we are maintaining 60-40. 60% is own manufacturing through our dedicated Badugar factory, which has a capacity of producing approximately 18 to 20 lakh garments, which as of now is fulfilling our 25% requirement, plus my job worker is 35%. So we are controlling own manufacturing through job worker as well as factory, which is broad, largely 60%, and knits and accessories is 40%. And going forward also, this ratio is largely maintained.
Got it. Sir, whatever we are manufacturing at our factory, let's say right now it could be around 25%, the 18 to 20 million pieces. Should that be contributing to better margins for us?
Yes, suit, that is a specialized suit unit. Obviously, suits are having a that's a specialized suit plant. They are having better margins, yes.
Okay.
And it is difficult for other units. You can have a small unit for shirt, trouser and other things. So it is a completely technical or imported machine. It's a big setup. So that is why the moment our requirements will increase, we are expanding our existing suit facility. They have better margins.
Got it. Got it. You said this manufacturing is for suits, blazers.
So this is the facility. This is specialized suit plant. However, there we produce suits, coats, blazers in category, formal trousers, formal shirts.
Got it. Yes. Okay. So now, now that we are likely to have a cash surplus, are we looking at expanding the capacity here or insourcing more and more production at some stage, maybe 1 or 2 years down the line?
So, sir, we are actually core retailers. So our focus area is retail. But we need to largely 60%, as I said, would be maintained, but largely would be outsourced to the job worker rather than establishing one more own plant.
Got it. So we want to focus on retail and whatever we have on the manufacturing side, broadly we continue with that. Is that understanding right?
Yes.
Got it. So sorry?
Job workers are going to increase.
Got it. Makes sense. Got it. Sir, in the earlier calls, you were talking about trying to explore an export opportunity and you were trying to explore something in Nepal. Can you update us on that or any other export plan?
So we still have 4 stores in Nepal. Nepal we have a master franchisee where we can move. We are exploring it, but on a immediate basis, India is so big, we are expanding. 1,000 crore is the target, then we have to make it forward. But we are exploring. Anything good opportunity comes, we are definitely going to go for that.
Got it. You said you already have 4 stores in Nepal. Is that right?
So we have a mix of multi-brands and EBOs there. So multi-brand and EBOs combined makes 4 stores in Nepal.
Oh, okay. And you were looking at appointing a master franchise or something. So is that, can you give more detail if that's possible?
Master franchisee for overseas you are asking about?
Yeah, either overseas or Nepal in particular.
So, for the Nepal we have a selling distribution kind of model, not exactly the master franchisee. And for the other countries, we are not doing business in the other countries. But yes, when we will do, we have to figure out whether we go with the joint venture kind of model or the master franchisee kind of model. So that we will figure out with the partner we will be getting.
Got it. And what would be contributions from Nepal to our consolidated sales? Would it be 1% or it would be negligible?
No. As I detailed today, it's hardly 3 stores. We are comparing 650 stores to 3 stores. But we are doing approximately on annual basis 1.5 year of the business is for these 2, 3 stores, 1.5. Because margins are lesser, we do not have any retail costs. So their transfer pricing is much lesser than what we are selling to our over the counters in our stores.
Got it. Sir, any progress we made on fast fashion? That is another piece that we were exploring. So can you share some details on that?
No, fast fashion category we are not exploring because we always said that we are into the basic kind of fashion. So we are a brand which are closer to the collection like Uniqlo. We are not doing products like Zara which are into the fast fashion. So we want to remain into this category. Yes.
Got it. That's it from my side. Thank you so much.
Thank you, sir.
Thank you. As there are no further questions from the participants, I now hand the conference over to Mr. Deepak for closing comments.
FY26 has reinforced the enduring strength of Cantabil brand, delivering record performance, strong consumer traction, and robust financial results. Guided by Vision 2027, we remain focused on accelerating expansion, deepening customer engagement, and driving sustainable long-term value creation. We thank our shareholders for the continued trust and look forward to building on this momentum in the years ahead. We hope we have been able to answer your queries. Please feel free to reach to our CFO or IR team for any clarifications or feedback. Thank you all.
Thank you. On behalf of Cantabil Retail India Limited, that concludes this conference. Thank you for joining us, and you may now disconnect your lines.